Hello traders, welcome back to the channel. Take a look at these two figures. Can you identify the difference between the highlighted portions? Obviously, both of them are fair value gaps. There is no doubt about it. But let's see what the price does next. And this is what happened. Now tell me, what do you observe? In the first scenario, price respects the fair value gap and it reverses, while in the second scenario, price mitigates the imbalance and breaks below the fair value gap, which was unable to hold the price. A broken fair value gap like this is not trash or useless. Instead, it is equally useful like a fair value gap for prices, but in the opposite direction. So this is what we are going to learn today. In this episode, we will learn in detail about inverse fair value gaps, from its formation to identification and how to use them for our trading. This is going to be a very informative video. So give this video a like so that the YouTube algorithm knows that you are interested in such content. And also subscribe to this channel if you haven't already. Now let's head back to the video. Let's begin with a brief introduction on what a fair value gap is. Basically, a fair value gap is a 3-candle structure indicating a gap between the high and low of the first and third candlestick as shown on the screen. It could be a bullish fair value gap or a bearish fair value gap depending on the direction of its formation. A fair value gap, as you may already know by now, represents an imbalance or inefficiency in prices in the market. And imbalance, as the name suggests, represents an area of unequal market movement where there are either only buyers or only sellers existing in the market. There is an unhealthy price delivery because it shows disequilibrium between buyers and sellers. So an imbalance means unfair price action. Another important thing to note is that the wicks do not fill each other, and if they do, then it is healthy price action or efficient price delivery and not really an imbalance. An efficient market is one in which the wicks do not have a gap between them and they actually meet. So to put it simply, market inefficiency occurs when the wicks are separated by a distance or a gap and they do not meet or overlap. So when there is an imbalance in prices, the market always tries to balance it. Therefore, fair value gaps acts as price magnets, always attracting the market towards it. Now, that's a quick recap on fair value gaps and imbalances. Now, let us understand what an inverse fair value gap is. An inverse fair value gap, also known as inversion fair value gap, is a failed fair value gap which is not respected by the price. In other words, an inverse fair value gap forms when a fair value gap gets run through or it fails to hold the price and the price goes beyond breaking the fair value gap. Now, to identify an inverse fair value gap is very easy. At first, you need to identify a fair value gap formed in prices. After identifying a fair value gap, look for a price retracement back to this fair value gap, but instead of respecting this fair value gap and reversing in the prior direction, price should close beyond the fair value gap, thereby forming a break in the opposite direction. So when a fair value gap is broken, you can mark it as an inverse fair value gap or an IFVG, and you can use it to trade in the opposite direction. In fact, an inverse fair value gap signals the most initial shift in the price momentum. You see, on most occasions, when price returns to balance a fair value gap, it respects the fair value gap, reverses, and then continues its move in the ongoing trend direction. But when a fair value gap gets violated or run through, it acts as an inverse fair value gap, and usually it signals the first shift in momentum of price, which can result in a short retracement or a change in direction later. This is most significant when you move down to your low time frames like 1 minute or 3 minutes. You can also see this happen during the manipulation phase in the market. I will talk about this soon enough. But first, let me discuss the different types of IFVG. Since fair value gaps are of two types, so the inverse fair value gaps also has two types. There are bullish inverse fair value gaps and bearish inverse fair value gaps. So a bullish IFVG is basically a bearish fair value gap which is violated by the price by breaking and closing above it. So first of all, you have to identify a bearish fair value gap, and when price breaks and close above the bearish fair value gap, it becomes a bullish inverse fair value gap. So the key points to keep in mind is that a bullish inverse fair value gap gets formed from a bearish fair value gap. Secondly, we need a proper break and close of a candle above this bearish fair value gap to be considered a bullish IFVG. A candle wick popping just above the bearish fair value gap like this won't suffice. We need to make sure that the candle body closes above the bearish fair value gap. Now, once your bullish inverse fair value gap is identified, it could now act as an area of support for prices. Therefore, we could expect the prices to push higher from this area of support. In other words, a bullish inverse fair value gap indicates the losing strength of sellers and an initial shift in the momentum towards the buy side. And there is a reason why I say this. You see, a bearish fair value gap is also called a CB. It means there is a sell side imbalance and a buy side inefficiency. It means that the sell side was offered but the buy side wasn't. So it is inefficient. Or simply put, it represents a fair value gap where bears have overpowered the bulls. It is also known as undervalued fair value gap. Now, in most of the cases, the price would increase in the future to balance this buy-side inefficiency. But when it comes to these bullish IFVGs, the price carried on higher despite balancing out the inefficiency associated with the bearish fair value gaps. This shows bullish intent. I have plotted some more examples of bullish IFVG and how it supports prices to move higher. You can pause the video and check this out if you want. Now, a bearish IFVG is just the opposite. So, a bearish inverse fair value gap is primarily a bullish fair value gap which fails to hold price and price breaks and closes below it. In this case, at first you have to look for a bullish fair value gap, and when price violates it by breaking and closing below it, it becomes a bearish inverse fair value gap. Here also, make sure that it is not just the wick projecting below, but the candle body has to completely close below the bullish fair value gap under consideration. Now, once your bearish inverse fair value gap is identified, it could act as an area of resistance for further price movements, and we can expect this resistance area to push price towards the downside. In other words, a bearish IFVG signals the dropping strength of buyers and an increasing strength of sellers. Now, just like the previous case, there is a reason why this happens. So, a bullish fair value gap is also known as a BC. BC stands for buy side imbalance and sell side inefficiency. This means that the buy side was offered but the sell side wasn't. So, it is inefficient, or it represents a fair value gap where the bulls have overpowered the bears. It is also known as an overvalued fair value gap. It means that the price of the asset is higher than its fair value. Now, in most of the cases, the price might decrease in the future to balance this sell side inefficiency. But when it comes to these bearish IFVGs, the price declined even lower despite balancing out the inefficiency associated with the bullish fair value gaps. Now, this shows strong bullish intent in the market. Now, here are some more real chart examples of bearish IFVG and how it acts as resistance for prices. Now, before I get to the next part, there is one concept that I need you to revise. It is the concept of consequent encroachment associated with the fair value gaps. Now, don't let the name scare you. The idea is very simple. Consequent encroachment is nothing but the 50% of the fair value gap. So, if I draw a Fibonacci retracement from this high of the first candle to this low of the third candle forming a bullish fair value gap, then the 50% level is the consequent encroachment level. Likewise, you can plot the 50% consequent encroachment level of a bearish fair value gap using a Fibonacci tool starting from the low of the first candle to the high of the third candle. Now, once you draw the consequent encroachment level for a fair value gap, you don't need to redraw it for an inverse fair value gap because the 50% level remains the same. This 50% level is very important when it comes to trading fair value gaps and inverse fair value gaps alike, because our trade entries, risk management, and reward to risk potential relies heavily on this level. Now, inverse fair value gaps can appear just about anywhere on the chart, and if you go after each and every single one of them as they appeared, you would end up losing a lot of money in the process. So, not all the inverse fair value gaps are worth our time and attention. So, the next important thing you need to understand is how do you identify the high probability inversion fair value gaps? And when do you use the inverse fair value gap for your trades? Starting off, inversion fair value gaps that appear after sweeps of liquidity tend to have a higher chance of holding the price. The areas of liquidity that I'm talking about can be in the form of daily highs or lows, equal highs or lows, supports and resistance zones, or any lows and highs clearly sticking out with deep wicks. You also need to keep the larger market context in mind to make a good prediction of the high probability inverse fair value gaps. For instance, if you are on a bearish trend with lower highs and lower lows forming like this on your 15-minute time frame, the lower highs can serve as areas of liquidity that the price could sweep before continuing the bearish run. Now move down to a lower time frame chart like 1 minute or 3-minute chart. Now look for an inverse fair value gap that gets formed when the price starts moving lower. Most probably, this could act as a resistance area for the further decline in prices. You could take trades from the consequent encroachment or at the lowest level of this bearish IFVG depending on your risk appetite. Now this could turn out to be a very profitable strategy if you combine it with the power of 3 or accumulation manipulation distribution setup. We will talk about this in our upcoming episodes. Another way to spot high probability inverse fair value gaps is to mark out premium and discount areas of price swings on your higher time frame chart. Now, as you may already know, in a bullish price leg or a bullish price swing, the discount zone is the lower half of the leg and the premium zone is the upper half of the swing above the equilibrium line. The idea behind premium and discount zones is that price will likely retrace at least to the 50% Fibonacci level during the pullback or corrective move before it continues in the ongoing trend direction. So during a bullish trend, any demand zone like a bullish fair value gap or a bullish order block within the discount zone is more likely to hold the price. Now, when the price taps into the demand area in the discount zone and starts moving higher, switch to your lower time frame chart and look for a bullish inverse fair value gap on the way up. This could be the first sign that the retracement is complete and that the trend is about to continue higher. Such IFVGs tend to be stronger in nature. You can use the consequent encroachment of this inverse fair value gap for taking your long trade entry by placing your stop loss just below the IFVG or below the lowest candle's wick based on how much risk you are willing to take. Yet another way to spot high probability inverse fair value gaps is during a failed market structure shift. It is very common for traders to switch into the lower time frame when the market reaches a higher time frame supply or demand level. These traders move down to their lower time frame structure and they try to catch a market structure shift on this lower time frame and then get into a trade on a fair value gap that gets formed during the market structure shift. Even though a fair value gap can be a good trade entry point, it can also act as a good inducement level for a further off supply or demand if it fails to hold the price. Now take a look at this case. The market came into a supply zone in the 4-hour time frame. In the lower 15 minutes time frame, we can see a market structure shift being formed with a fair value gap breaking lower. Now most traders would plan to take a short trade from this fair value gap, but instead of price respecting this fair value gap and moving lower, price violates this fair value gap and starts moving higher towards the nearby higher time frame liquidity zone. So this becomes a bullish inverse fair value gap that could support future price movements. You could use this inverse fair value gap to trade into the higher time frame liquidity zone. You can use the consequent encroachment of this inverse fair value gap for taking your long trade entries by placing your stop loss below the IFVG. So these are all the important things that you need to know about inverse fair value gaps. In the next episode, I will talk about a related concept, which is the balanced price range concept. So stay with us to find out. Meanwhile, if this video was informative, kindly hit the like button so that the YouTube algorithm knows that you are interested in these type of videos. And if you have any doubts or suggestions, do mention it in the comment section. Also, share this video with your friends and fellow traders. And if you're new to this channel or you have not yet subscribed, make sure to subscribe to help us complete the 1 million goal by the end of 2025. I'll see you guys in the next episode. Till then, bye.